I welcome everybody to our end of May 2020 vision update. We felt it important to reconnect and share some information. We've got quite the set of data to go through today. I think it will help put some perspective into what's going on in the markets. Just disclosure, everything in this webinar is for educational purposes only. Nothing we talk about is intended to be used as investment advice. Obviously, we're not trying to sell any products here as well. And if you have individual questions, I think there's a chat box. We can figure out how to get questions submitted that way. But also feel free to email or call us if you have individual questions regarding your specific situation. So today we're going to start here with this chart of the S&P 500. And the title here is, what is wrong with this chart? And of course, what this shows is that, you know, we are pretty daggone close to the market on a relative basis, getting back to its previous high, despite a lot of things going on in the economy that traditionally would be red flags. So what I wanted to illustrate here or talk about is that we're going to show you a lot of information that is very alarming to us and put some context as to the things that are happening as we have this battle going on between essentially our federal government and the power of the purse versus this virus, COVID-19, and the widespread implications of what that is doing to our economy. As this chart shows, the market is pricing that things are perfectly okay. I mean, we're within 10% of an all-time high, and things tend to be looking good from the market standpoint. But I think we have to really realize to see what's going on behind the scenes. And so this crazy looking picture is really to illustrate, okay, the virus has created havoc everywhere, you know, shut down businesses, it's created economic problems, and the government is like, hey, we're just gonna fight it with money. And I think that it's unknown territory as to what happens with this battle. And that's a problem because it's hard to invest in things that don't have a lot of historical precedent. That said, it's really important for everybody to realize that post COVID-19, and you look out 10 years into the future, or 20 years into the future, we here at our firm are still in the camp that our demographics, we have an incredible number of millennials that are getting into the age ranges for peak earnings. Our capitalistic structure where people are paid and incentivized to get up and go and make a living and put food on their table for their families every day. Our laws around intellectual property. So for somebody to, you know, design, invent, create something and make a living, make something awesome, you know, and have the ability to get paid on it for years and years and years. The system that we actually employ in our country to promote wealth building, it's fully intact. It's just temporarily got a problem because of the virus. So long term, our view is that people will be, they'll be fine as investors in the long run. But we have got one heck of a bumpy road right here in front of us. And so the rest of this presentation is really to just point out these pitfalls that are right in front of us and maybe how we want to handle it. So with that, maybe Brett could take us through a few of the data points, and we'll get started with that.
Yeah, so I think now that really the shutdown started, you know, in I guess early March, so you're starting to finally get some actual economic data that's coming out that's kind of beginning to show us the impact of what that has done to different sectors of the economy. And we're not gonna go through all these slides in super in-depth detail, but we want to just show you kind of how the shutdown and how the virus has impacted all different parts of the economy. This first chart basically looks at continued claims as a percentage of the civilian labor force. And we basically set up here at the top of the page, let's start with unemployment. And really the reason for that is that I think we believe that that's going to be the key data point that we watch going forward that kind of tells us how long this recovery is going to take. And there's really two pieces to that. Number one, how many of these job losses that we've had are going to be permanent? And then number two, how quickly, right, are some of the ones that are not permanent going to come back? And if you look at some of the data that's come out, I mean, I think we've had something in the neighborhood of 40 million initial jobless claims since March, which is just unreal. And of that, there's a pretty significant number of those that are continuing claims as well. So I think if you calculated the actual true unemployment rate right now, it's something around 20 to 25%, which is near what it was back during the Great Depression. Now, we don't expect that to last forever, but nobody really knows right now how quick some of those jobs will come back and how many of those job losses will be permanent. We've seen projections anywhere from maybe 20 to 40% of the job losses could be permanent. And if that's the case, if you calculate that we started this thing with about a 3.5% unemployment ratio, you could be looking at, even after this, after a lot of these jobs have come back, a high single digit or low double digit unemployment rate. And when you have that in an economy that's 70% consumption based, that's a huge headwind for stocks and for the economy to do well. So that's why we kind of started out with unemployment, because we believe that's going to be kind of the key indicator that we watch as we go forward. But this shows you the unemployment employment to population ratio, which is 51%. This is, if you look back historically, this data goes back all the way back to 1949. And there's only been one other time when it was lower, and that was back in 1949 during World War II. So only 51% of our population that's work age is basically working right now at the moment. The next slide, I think, looks at cyclical economic indicators like total vehicle sales, and this measures them on a month-to-month basis. They're at their lowest level ever recorded, and data goes all the way back to 1976, and this was for the month of April. Next slide is basically retail sales. And so I know a lot of retail sales have obviously moved online because you don't have the option to shop in store in a lot of places. But this is down 17.8%, which is basically the lowest it's been since 1992. So going back decades, the largest year-over-year change. Housing starts, right? Going all the way back to, it's down 30% over the last month. Largest monthly decline ever, going back to 1959. The next slide is industrial production, which basically measures the industry sector, the industrial sector, which includes things like manufacturing and mining and utilities. Year-over-year change, down 15%. The next slide is the U.S. capacity utilization rate, which kind of measures as a percentage what our economy is producing, which is a kind of a good indicator for the growth and the strength of the economy. It's down to 64.9, which is basically the lowest going all the way back to 1967. The next one shows services, so non-manufacturing. So this is kind of we looked at a slide with industrial production, but this is actually looking at the manufacturing or the non-manufacturing services sector. And this is big because our economy is, for a long, long time now, has been transitioning more to a service-related economy. And as you can see, this is down to the lowest level since 2009. So that was a lot of different slides. And I think the reason we tried to add a lot of different slides from several different industry types, just to kind of show you that it doesn't really matter, from housing to retail to autos to unemployment to industrial production, services, doesn't really matter. Everything has been impacted by this. So.
Yeah, this is Justin. That was a lot of rapid fire bullets, but like Brett said, the point is none of them are very good. When you take an experiment and you shut down an economy basically for a number of weeks and months, you don't expect them to be good, but they materialize themselves in earnings. And when we look at earnings, now you're starting to, what really matters as to valuation in the stock market a little bit more. When we just look at $12.56 a share quarterly, you can see the drop off and that's kind of what we're seeing materialize in earnings. Backs some of the worst since coming out of the 08-09 markets. So quarterly earnings have been deteriorating rapidly. And then when we go to look at year over year.
Well, hang on, Justin, on that real quick. So in the first quarter, that $12 per share is representative of the whole quarter, but you got to think about, we only shut down the economy for 3 weeks of the first quarter, right?
That's correct.
So the impact of COVID shut down the economy 3 weeks of 1 month of a quarter had a staggering impact. I think that, you know, that's not even a whole quarter. I just want to point that out.
That's a great point. I mean, you basically almost got half. I mean, it feels like it's just in our lives, we've been dealing with this thing for years now. I mean, everybody's just tired, right? But it's a great point. I mean, that's really only half the quarter. And then when you look at year over year, a 64% decline, that's a big deal. And kind of one of the larger points, and we'll touch on this later, is that leads into valuations, and is the price of the market, is that truly reflecting what we're seeing in earnings? And I don't know that it is quite yet.
Yeah. I think this is Lynn again. In one of our earlier calls, maybe in April, we took some data from Deutsche Bank, who had projected that, okay, if we shut down the economy, we'll have earnings decreases, you know, and actually they had a number of about 60%. And the real thing that they stressed in their white paper that they had put out was, well, how long does the economy stay shut down or in that limited capacity? And for each month that, you know, goes by where we are operating as limited capacity, you get exponentially more difficult to restart or to bring back that consumption or bring back those jobs. And you know, the valuation of the stock market today is as if we are fully reopened and back in business. And I mean, it's a challenge. I mean, even think here in North Carolina, we've got the whole phase 1, 2, 3 thing going on. But if you look at what has to happen for us to move from phase 2 to phase 3, it may not happen for a very, very long time. And I think a lot of states are in that same position. So these earnings just reflect a very small part of one quarter that's been has faced the impediment of dealing with COVID. And we haven't even seen Q2's stuff start to forecast.
Hey, Lynn, can you hear me?
Yep.
All right, perfect. So one comment on that. I mean, the earnings for Q2, right? If you look at a lot of corporations, they typically give you guidance for what the next quarter, you know, future is going to look like. And, you know, what we've seen here recently is a lot of, most companies have just removed all guidance because it's so bad, you know, they can't even project what it's going to look like. And it's so volatile. I mean, things swing, you know, to the good and to the bad. There's no way to project anything. So all these people and analysts coming up with, you know, what's their expectation of what earnings are going to look like for Q2, you know, are just shooting in the dark because they have no idea what, you know, corporations are going to be looking like. And it's, like I said, the number for Q2, it's going to be significantly worse than Q1. I mean, it's been 2 months already, and most of, you know, the country is still shut down. So
yeah, so that's an alarming thing for us. Knowing that valuations aren't reflecting that information.
Let's shift to talk about debt and the deficit, and we'll start with the corporate debt. This slide shows corporate debt to the GDP ratio, and this hit an all-time high pre-crisis. So this is before COVID was known. Think corporate debt to GDP, that a company has $1 that comes in, the ratio of what they have to spend from that $1 to service their debt is at an all-time high. So as profitability slows and earnings slows for companies, more of their earnings have to go to service that debt. So if they want to continue with the same profitability that they've had, they've got to make cuts. And that could be fewer share buybacks, which most companies have suspended, or it means job cuts. Or they're just going to be making a lot less from their bottom line, because obviously their profitability is slowing. So if they keep that same ratio of debt payments, the earnings they're going to have after they pay off everything, including paying their employees, is going to be drastically different than what it was at the end of 2019. We've all seen the explosion in government debt. The Fed and the Treasury both have thrown everything they can at this. And this chart shows the speed in which we're adding trillions of dollars of debt. We went from 24 trillion to 25 trillion in 28 days. And it's a willingness on both political parties to solve this. And I think right now we're at a pause waiting to see how the stimulus that has been put forth so far actually feeds into the economy. But both parties agree, and they may not agree on how exactly to do it, but both parties agree that there will be more in the future later this year to keep the economy propped up.
Yeah, and I think where the challenge with government debt is that we always know that they have to pay the interest on that debt as part of the ongoing federal budget. And so each year when they collect taxes from the taxpayers, they have to decide, right, how much are we going to spend on military, how much are we spend on Medicare and Social Security and entitlements, and how much are we going to use to operate the business of the economy. And when more and more of that money coming in the future has to go to pay debt service, it just makes it so that the government has less money to operate with. And so ultimately, what we've seen here in this crisis, and we also saw it to some degree in the financial crisis, is essentially the creation of new money. And when you create more new digital money, if you will, that has a very big inflationary long-term consequence, is what you would assume. We aren't seeing it yet because we only have 64% capacity utilization in our economy. But when we do get to the other side of this challenge, and you have the debt issue and you have capacity is now getting reached again, you know, the amount of dollars that they've created in this could create inflationary problems. So there's a whole myriad of cascading effects of the debt issue. And anyone that tells you here's what's going to happen with any degree of certainty would be inaccurate, because you don't know. I mean, it's very difficult. It's uncharted territory, but we're concerned about it because from the earnings standpoint, as Jason said, I don't think you can have a reasonable expectation that companies are going to be able to make the money they made before, because they're going to have so much more debt to pay, you know, and then their taxes are going to be higher because the government's got to make enough money to cover the debt that they're creating. So it's some seriously challenging things going on here.
And it's important in that same line of thinking, Lynn, that will probably keep a lid on interest rates well into the future. Because if interest rates go higher, companies and countries are going to have a massive problem servicing that debt. And we're not the only country that is slashing interest rates this year. 77 other countries have cut interest rates. A lot are negative, or a lot of countries are at zero or getting very close to zero. So they're trying to stimulate the economy by saying, you know, if anything you put in the bank is going to pay you nothing, so go out and spend, go out and invest. That's a dangerous proposition, especially if rates ever get away from the Federal Reserve, whether here or other countries. But right now, everyone in the world is in the same boat we are, slashing rates, spending government money. The question is that enough to hold all the economies over until everyone's back fully employed?
Yeah, so that story still remains to be written as to how that's going to turn out. Somebody want to talk about valuations?
Yeah, I think what this chart shows, and it's specifically the NASDAQs, I think tech industry, not very much has changed from 3 or 4 months ago from the tech companies. It's a dramatic V-shaped recovery there. So if you think online shopping, you know, social media, and I know we're not supposed to name individual companies, so not talking about their businesses, but think those industries, those seem to have not been hurt like other old-fashioned companies, banks, industrials, energy. You can see this recovery in the Dow is much more muted. So a quick rebound and then a flatten out over the last couple of months. So the NASDAQ has experienced almost a complete reversion to where it was, where the rest of the economy is kind of flatlined after that initial bounce back.
Yeah, and what we don't have here is a chart of some other more broader market segments like the Wilshire 5000 or perhaps Russell 2000, where you're dealing with like even the mid-size and small-size companies. And if you were to see those, it's much more like the Dow situation where there was a bounce, but it's still way, way, way down off the highs. So the S&P 500 is typically what a lot of people would say benchmarks the U.S. economy. That's the chart we started with. I said, what's wrong with this chart? Because it's actually had a pretty substantial recovery. It's 10% or so from the high. But in the S&P 500, really the top 10 companies are a huge contributor to it, and they're mostly tech, and they're at all-time highs. So there are definitely some challenges going on with the market and valuations, but overall, like the big tech stuff and the NASDAQ and even the S&P as a whole, they don't look to represent the challenges that we really are facing. John, you want to talk about the GDP ratio?
Yeah, so this shows the Wilshire 5000 versus the GDP ratio of the US. And what you can see here is, if you just go back to 2000, the crisis where tech got valued significantly high in terms of their PE ratio. You look at 2007, 2008, and really valuations relative to what the U.S. government actually GDP produces, and we're pretty much near at this point an all-time high in terms of how much Wilshire 5000 is valued relative to the GDP of the U.S. So it's a significant indicator in terms of showing that we're not at a cheap state right here. It's very expensive, and the earnings and the economy, or the stock market are going in one direction, and the GDP, it doesn't really match what we've seen in terms of GDP. The historical average on this one is a ratio of 0.8, and we're trading well above that. And the last couple of times we've seen it are at the point where there was a significant peak in the market, and we had a pretty big drawdown after that. So it's a valuation measure that shows we are significantly overvalued relative to this 30-year chart, so or 50-year chart. So a long time period we have high valuations.
So hey, listen, I don't mean to make this more complex and get too deep into data, but I want to go back to what I just shared a minute ago. So the Wilshire 5000 is a much broader index than, say, the NASDAQ or even the S&P, because the S&P is so heavily weighted with the top key tech companies. The Wilshire 5000 really represents a lot more parts of our economy. And that group of companies and sectors and stocks that make up the composition of that, they are not near all-time highs. They have not recovered to the same degree. It went down and it came up a little bit. So the valuation in terms of the actual dollar amount valuation of the Wilshire 5000 today is not near an all-time high price-wise. So when you think about that in the context of that value relative to GDP, we're not looking at a fully recovered pricing. We're looking at the actual pricing of the Wilshire 5000 against what our GDP can produce right now. And we're already at a relative all-time high of the actual value of the Wilshire 5000 compared to the GDP. If the Wilshire 5000 were to go back to where it was priced in January, this chart would be insane. I mean, it would be way higher than any measure we have ever seen. So I hope that makes sense. Feel free, guys, to jump in if you don't think I'm making any sense with that. But this is a muted valuation of the Wilshire 5000. Even with that muted valuation, it's as high as it's ever been in history. So hopefully that makes sense. If it doesn't,
it's also a muted GDP number.
That's right. It's because the GDP is so bad right now.
Yeah,
That's
it's not catching the last month or 2 months of almost complete economic shutdown.
right.
So both sides would get even further apart.
Yeah, I can imagine this yellow line going straight up off the top of the page if we go another quarter and we have GDP further decline and the market doesn't have a pullback. But we'll move on. Things are expensive. This is probably the most important slide on the entire slide deck, and this is probably the one that makes it so that I don't sleep well at night, is this slide right here. Who wants to go through this one?
I'll touch on it. This is Justin. I think this is what everybody's trying to make sense of because it doesn't make sense. You have prices that are moving opposite direction of earnings, and historically that doesn't happen. The price will follow earnings, and so if you ask, well, why is that? Well, there's really only a few reasons. It's multiple expansion, which means that investors are willing to pay more for those earnings. We don't even really know where those earnings are going to go. That's what makes it really, really hard to evaluate or look at stock prices right now. Investor sentiment's really kind of what's keeping this thing going. I mean,
It's almost like it's pure air, right? I mean, it's there's no earnings to support the valuation. Look at the bottom of this chart. Earnings since March steadily and dramatically declining, and yet the market just keeps climbing higher, right? And it's like whoever is paying more and more and more for shares of the market is clearly not paying attention to the fact that earnings are substantially declining, and they haven't turned up yet. Like we haven't said, oh, it's getting better. It's flattened for the moment, but there's even no guarantee that it won't continue down further, because in the data that has been presented to Wall Street from these corporations is a quarterly earnings from the first quarter, which was only impeded by 1 month. So this is very crazy to me to think that we continue to see the market just proceed as business as usual when it is not business as usual. And we contemplate, well, why is that? What could possibly be the reason? And there's lots of things we could, theorize, but I mean, ultimately it's consumer confidence, investor confidence. And it's also the sheer dollars of volume of money the Fed has created and the government is put out there. And there's a lot of people that maybe don't even look at this data. They're just, oh, it sounds like things are getting better. Let me go. I have had so many clients come in. I think we should go buy some stock in movie theaters because they're going to open soon. Well, that doesn't really work like that. I'll give you a perfect example. Again, I know we're not supposed to talk about individual companies, but think about, you go to a place of business that the parking lot's slammed full and there's tons of things going on. You're like, man, they're probably doing all right. But when you look at their earnings reports, you realize, they're not actually doing all right. Because what we can't see is they're having to pay their employees double time. And they're having to spend money on all sorts of protocols that, they don't normally have to spend money on it. So anyhow.
I think sometimes, Lynn, as an investor, it's hard to differentiate when something is down in price, maybe 20, 30, 40% doesn't actually mean that it's cheap.
Yes. Yes, I agree. So we want to make sure people realize this. And because of this, we continue to take a more conservative position. You want to talk a little bit about the Shiller PE?
So if you look at the Shiller PE, what they're doing here is basically taking the PE ratio and averaging over the last 10 years. So it kind of gives you a more broad indication of what earnings have done, not just what it's doing right now, but looking back and averaging over the last 10 years. So this chart goes for a long time period, right? So you can see the Great Depression, you can see the Black Monday, you see 2001, 2002, 2008, and where we're at from a historical standpoint, when you look at an average, is a very high valuation of of the stock market relative to the earnings that it's producing. And I think this is even, like we've talked about in the last couple of slides, is even underestimated because we think the earnings would likely be declining and the price has been increasing. So when you factor in what this is going to continue to look like for the next couple of months, I think this specific point here where it's 27 odds are it's probably going to go up when your earnings are going down and your price of the stock market is continuing to rise. So we're getting into valuation scenarios that have only come in right before significant drawdowns. You know, Black Tuesday was a very big drawdown. 2001, 2002, big drawdown. 2008, huge drawdown. You know, so you're getting to this point where, you know, the earnings would have to go up substantially to validate the price where it's at today. The last slide showed it, that we're kind of getting a huge divergence, and that isn't even, you know, factored into this numbers, you know, because we haven't really had Q2 earnings yet. So I think it's a data point that, you know, we're going to continue to watch because it has a very big impact on longevity and opportunity in this market, because obviously it's not cheap. So next slide is a put call ratio. I know most of you probably heard of Warren Buffett. He had a famous quote, when people are greedy, you should be fearful, and when people are fearful, you should be greedy. Meaning, when investor sentiment in the market is good and things are gonna, you know, euphoric, things are gonna continue to go up, you know, you should take a defensive stance, because that's when, you know, all the money has flown into the market. So what this ratio is showing you is a put to call ratio, which basically means a put makes money when the market goes down. So the higher the ratio, the points at the top of the chart mean people are being very defensive. Again, based off Warren Buffett's, you know, famous quote, when people are being defensive as a whole in general, that's when you want to be bullish. You want to be invested in stocks. When people are being, you know, fully bullish at the bottom and investing money in call options and not buying any protection, well, that's when you probably want to be protected. Again, it's the kind of a contrarian indicator, but you want to be taking the stance of, okay, the entire majority of, you know, investors are moving to a position of not really protecting their portfolio because the market's been going up significantly from here. So the odds, if we do get a pullback, the odds of it being a pretty steep and, you know, sizable pullback increase, because we're coming at a point where nobody's being protected. So what you have is people moving from being very bullish to the chart. When you get a downturn, people turn very bearish and buy a bunch of put options, and it drives the stock market down even further. So it's just an indicator that shows there's people that are investing, as our, you know, last couple of charts have shown, in the market in a very, very bullish case. So
Yeah, it's really alarming. There's a lot of things about the valuation of this market at this moment relative to earnings that are more alarming to me than any other point in my 26 years of doing this. And I understand the argument that people are looking forward. They're looking to the future, past the COVID environment, and saying these companies are going to have opportunities and there's so much free money running around, and I'll get it. I get that they're looking forward, but valuations are really high. And the last couple of times that I've seen valuations at this level, people didn't just get hurt, lives got destroyed. People's hopes and dreams flushed. And so that leaves us in a precarious place, because we don't know what the recovery will look like. Are we going to have 40 million jobs come back quickly? I mean, it took us 15 years to get 20 million jobs into the economy since the last recession. Are people going to go back to work and pick up where they left off, and consumption and, you know, borrowing and cyclicals pick up? I don't know. But I do believe that the longer we go on with things shut down, the less likely it is that it will recover to the degree that the market is forecasting. So what do we do with that information? Justin, you want to kind of give us some conclusions, I guess, in terms of just talk a little bit about what we're doing here in regards to how we process this information? How do we translate that into the portfolio management process that we run?
Yeah, a few real quick things. My conclusions. I mean, like you said to begin with, long term, we are positive. I mean, now, maybe that's longer than normal, but the U.S. has a history of overcoming, and I think that'll be the case here. we have to report on on the facts. We have to report on the data that we have, not the data that we wish we had. So don't mean to be so gloomy on this. It's just, those are the numbers. I think the most important thing for you, the individual client, is to look at your goals, your situation, and your plan. Some of you may not even have a lot of stocks in your portfolio. So we've focused a lot on stocks in this call, but you may not have a large stock exposure. And then just from kind of on a more global, from our client portfolios, we have a tandem strategy in most of them, right? So most of the portfolio will be kind of a fundamental analysis where we're looking at this data, and we may take a more conservative stance because of this data. But there's also a more mathematical trend following component where you don't really ask why, you just ask what. And if the market does continue to go up for reasons that maybe don't make sense, we can still have some exposure to that. So those would be my takeaways.
Anybody else have any conclusions? And by the way, folks on the call, this would be a great time if you have questions, you can type them in your Q&A box and we can address them as well. Anybody else want to add any conclusions?
I mean, I would just say that it's, if, looking at the data, we just scrolled through really fastly, it would be hard to make a case to be really aggressive right now. Right. And so from holistically, we're just across all different, investor profiles are a little bit more conservative at the time being than we normally are because of this data.
Well, I'll throw a couple of little thoughts and then we'll wrap it up. For our growth oriented folks, we're about half as risky as the growth world would be if you were to look at it, benchmark it right now. And that's about as far as we can stay out of growth and still meet that investment policy statement. If the market has another couple of good days, the trend piece will go back in and we'll probably be about 80% invested relative to most growth indexes. I will say, if we do go back in because of our trend following process, if the market reverts back down, we'll come back out again. We won't wait for it to fall off a cliff. So I think there's some good parts to that. For the more middle of the road risk level folks, which a lot of my personal clients are in that more total return balance camp, we don't have a lot of exposure to stock. In fact, we have so much exposure to bonds. Our team is really working very hard to try to make sure that the kinds of bonds we own are not necessarily going to get sucked into some structural problem in the bond market. So we're taking a little lower yield right now than we'd like to get because we're being a little bit more safe on the bond side than we normally would be, because I think there's some structural risks at work. But I don't think the stock market is really going to hurt our less aggressive folks if it does have a major pullback. And I would end that by saying, with trend process, we tend to make a good return relative to most in a really ugly market. Because, for example, our most conservative clients probably have, 80 to 95% of their money not in the market right now. And if the market pulls back 30% because maybe the world looks at the data a little closer and says maybe we're expensive, we still have that money in dry powder and we would just start to deploy that. So those are some big picture things. I got a couple questions and we'll jump into that. One question, this is, what is the view of the next stimulus package? So that could be a whole seminar by itself, but John or Jason or Brett, when you guys want to try to answer that one?
I see down at the bottom, it says also maybe additional stimulus for consumers and or businesses. I mean, there's a lot of proposals out there. The one that I think was interesting, and we were talking about it earlier here in the office, is there has been this sort of push to maybe, instead of sending somebody a one-time stimulus check that they can do whatever they want to with, there's talk of sending a one-time, almost like debit card that has to be spent in a certain time frame. And you might say, well, what's the difference? Well, the difference is if you do that, you're basically forcing people to consume something, right? To buy something, versus you sending the money in a form of a stimulus check with no stipulations. A lot of people are just saving it, right? And so that's not really spurring economic activity. Matter of fact, the data came out today. Sure, I know you might comment on this, but it was the highest savings rate ever in the month of April. And consumer spending dropped the most in month over month ever. So that's one of the proposals that we've seen that maybe would make some sense and might get some traction.
Yeah, and I think that also answers the question about the biggest indicator of the recovery. This, like Brett says, that personal savings rate hit 33%. The previous high was 17%. So that's a massive difference. So our question would be, is that forced savings, which to some degree it is, because if things aren't open, you can't go out and spend money. You have to save it. So looking out 3 to 6 months, does all of that spending go back in, or is this a structural change in people's lives where they're going to be saving more for the next 5 years because they know that the next shock that comes, they can't be sitting on $0 in savings? So I think that's one of the biggest indicators to look for, is how much does consumption drive the economy, because it's 70% of our economy is you and I going out and spending money.
Yeah, so I think the consumer spending indicators help to give us a sense of when we're really back on track for a sustainable set of long-term earnings. I think the other contributing factor to that is unemployment. I mean, we got to be real. I mean, 40 million people unemployed is not going to produce an economic output anywhere near what we've produced in recent, years. So, but they come hand in hand. As employment resumes, people will feel like, well, maybe I don't need to save as much because I have a job, I have an income coming in, I can spend it. So I think it's employment and consumption savings rates are the two biggest indicators to let us know we're really getting past the economic part of the problem. All right, gang, listen, thank you all for taking the time to join our call. We want to be respectful of your time. We're coming up on an hour. If you have individual questions or would like to talk about your portfolio or your plan or strategies, be sure to connect with us. You can email us, you can call us. We're here, we're working. Even when we're not here working remotely, our phones are tied to us wherever we go. We want to help everybody make great decisions and come out of this thing in as good a situation as possible. With that, I'm going to wrap it up and go through our final disclosures. The views of those of Adams Financial Partners and should not be construed as investment advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. All economic and performance information is historical and not indicative of future results. Please consult your financial advisor for more information. The S&P 500 index is an unmanaged index representing the largest 500 companies in the U.S. Barclays Ag Index is an unmanaged index representing the overall broad bond market. Investors cannot invest directly in the index. The performance of any index is not indicative of the performance of any investment and does not take into account the effects of inflation and the fees and expenses associated with investing. Past performance does not guarantee future results. All investing involves risk, including the loss of principal, is a possibility. There is no assurance that any investment strategy will be successful. Thank you. Have a great day.